Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Matt Weiner. He's managing director of M&A and Transaction Solutions over at Aon. We are going to take a look at U.S. private equity M&A and what the biggest trends are for 2023. Matt, it's great to see you. Welcome back to Trade Talks.
Yeah, Jill, great to see you as well.
What does the private equity M&A market look like in 2023 as we sit really, almost at the end of February at this point?
Yeah, so we're flat compared to last year. We're still seeing a lot of the same economic headwinds that we saw in 2022, which has led to kind of a flat start to 2023. The headwinds, very similar story. We're seeing increased borrowing costs, valuation disparity, and then just general uncertainty around economic conditions. Based on current forecasts that we're hearing, we're probably going to continue to see this muted start for 2023 with an acceleration in the second half of the year.
So what are the trends that you're currently seeing right now in the U.S. private equity M&A space?
Sure. So we're still seeing quite a bit of activity in the energy and infrastructure space, including in the renewable energy sector. We're also seeing quite a bit of M&A in the technology and healthcare sectors. We expect that trend to probably continue throughout the year. And I think the biggest trend that really we started seeing kind of in 2020, 2021 has continued for the last 2 years is around alternative transaction structures. So we're continuing to see private equity sponsors and limited partners look for ways to create liquidity. And so these alternative transaction structures continue to take a big part of that story.
So for these alternative transaction structures, what are you seeing more specifically in the market?
Yeah, so I think one is unique financing arrangements. One of the examples that we've seen are what are called net asset value loans or NAV loans. And this is where a private equity sponsor can borrow against the value of its underlying portfolio companies and then use those proceeds to do many things, including provide distributions to its limited partners. I think the most kind of prevailing structure though, that we continue to see are around secondary transactions. Right. So due to LP or limited partner liquidity requirements, portfolio allocations, and also with sponsors out raising new funds, we're seeing parties engage in these secondary transactions in order to help kind of accomplish some of these objectives.
What types of secondary transactions?
Sure, so secondaries is pretty broad. It can take on kind of a variety of transaction structures, but I think the two most common ones that we see are first what we call kind of a direct or traditional secondary, which is LP to LP sales. This is one institutional investor selling to another. And generally, they're selling a portfolio of interests that can run across a variety of different funds or managers, and they're selling those to new investors. The other is what we call a general partner or sponsor-led secondary. And this is where a current fund sponsor is contributing one or more of the assets that it owns from an old fund into a new fund. We refer to these oftentimes as continuation vehicles. And in these continuation vehicles, we're seeing the sponsor continue on and actually manage those assets under this new vehicle. And the monies that are being put into the fund from the new investors are being distributed to the old limited partner investors, thus creating that liquidity event.
So it sounds like these are relatively complex transactions. So what are some of the concerns and risks associated with that, and how are they looking to solve them?
Sure. So as you can expect, there's every transaction structure is going to present kind of new or unique risks. I think for secondaries, the first one that comes up is conflicts, right? Because you oftentimes have the same sponsor on both sides of the transaction. So the first thing that we're seeing sponsors often do is engaging with their existing limited partners, oftentimes through the Limited Partner Advisory Committee or LPAC, and working through the potential transaction to make sure that it's going to be fair and equitable for those existing investors. We're also seeing them engage third-party advisors to prepare fairness opinions, that the transaction, again, is fair and equitable and that the price being paid is the right price. And then, very common for them to engage an investment bank to run an auction process to ensure that you're getting multiple bidders that are coming in to look at that. I know from our perspective, particular to Aon, some of the areas that we're focusing on are some of the contractual indemnities and other obligations that can arise from these transactions. So as you can expect when you're negotiating these agreements, there are certain indemnities that can arise that result in certain holdbacks taking place or escrows being put in place. You also have challenges where a general partner may want to wind down an old fund from which it's contributing these assets. And so challenges around giving fund guarantees can result in not being able to wind down those funds. And then you have certain obligations that can arise that may be related to taxes, can be related to compliance with the old transaction agreements or partnership agreements. And then sometimes you have challenges around clawback, where distributions that were paid to old limited partners may have been may have not been properly allocated. And so one of the things that we're doing is working with kind of bespoke insurance capital to help effectively do a risk transfer so that those liabilities are removed from a transaction.
All right, Matt, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.